We're going to talk about monetary policy now, a very important topic in macroeconomics, one that's become controversial over time because of different events hitting the world economy. We're going to start with a very important topic in monetary policy, and that's central bank independence. Why do central banks have independence? What makes them lose it? Why is it important? The rationale for central bank independence has been discussed for many years. There's really three. One is what we'll call the gain then pain scenario, something that is quite evident when you think about the basic dynamic macroeconomic models. And so let's focus on that first. And then I want to talk about the political business cycle and the central bank being able to help the government borrow as two other reasons for central bank independence. What is the gain then pain scenario? You can illustrate it with the typical diagram for the macroeconomic fluctuations model, the ADIA model, the ADIA model, where real GDP is on the horizontal axis and inflation is on the vertical axis. This model is a description of the kind of macroeconomic model that many central bankers use in practice. What it illustrates here is this gain then pain scenario. So you want to start off in a situation where the aggregate demand curve is at a lower point there, and the inflation adjustment line is intersecting the aggregate demand curve at the point where real GDP equals potential GDP. So the starting point is, again, at this intersection right there. Suppose then that the central bank wants to stimulate the economy, to get the economy moving and to lower unemployment. Well, we know it can lower interest rates, and that's going to shift the aggregate demand curve over to the right, as is illustrated in the arrow in the picture. So that goes over to the right, and we have a new intersection. Real GDP has increased. There's a boom, unemployment's coming down. Over time, however, inflation starts to rise. The inflation adjustment curve goes up along the new aggregate demand curve, and it keeps going up. As we know, there's an adjustment of inflation and of interest rates. It keeps going up until you come back to potential GDP at a higher inflation rate. Higher inflation rate is not a good thing. People don't like higher inflation, and it may slow down the economy. So in a sense, we've got this initial gain where real GDP goes temporarily above potential GDP. It's temporarily high. And then there's an adjustment backwards, and you get an inflation rate which is higher, but real GDP is back to where it was at the beginning, at potential GDP. And that's the pain, is the higher inflation. So note that this is a time thing. The gain comes first, and the pain comes later. So you can imagine a situation where a central bank might want to stimulate the economy to maybe get a favor of people, get favor of the government, the people who are appointing the central bank officials, recognizing that the pain will come later, and maybe by that time people have gone. So this gain then pain scenario and the dynamics of that is one of the reasons for central bank independence. If you like, there will be less pressure on the central bank to provide these gains in the short run when the pains will be significant in the long run. And an example of that is the second point, the political business cycle. What we worry about with such a powerful tool that affects the economy is there'll be a temptation for a politician, say, that's in office, to make the economy look better to get reelected. And that gain is part of that. The economy is booming, unemployment's coming down, the politician gets elected, and then the pain comes later. The pain comes after the election, and by that time maybe the politician is off doing other things. People forget really where it came from. But this is really what a political business cycle is. The politics of elections causes the boom and then the bust, the gain and then the pain. And so the thought is that by having an independent central bank, which is somewhat disconnected from the everyday politics, and that's difficult in a democracy, let's face it, because this is a powerful organization. You should be careful about giving it independence relative to other parts of government, which is part of the democratic system. But that's the political business cycle, and you can see how it's very much related to the gain then pain scenario. The final reason on the list to have central bank independence is that central banks can make it easier for governments to borrow. Government might want to borrow because they can't raise taxes enough to help their spending, so there's a deficit, and so they'll need to borrow. As you know, borrowing comes when there's a deficit. If the central bank just buys the government's debt, really basically is lending to the government, then the central bank is helping the government borrow. It's making it easier for the government to increase its debt. It's making it easier for the government to run a deficit, and that, of course, can have its disadvantages as well. You have deficits will be too big, the debt eventually will grow, it could be crises, could be adverse effects on the economy later. And so that's another reason to have central bank independence. In that case, the central bank says, no, we're not going to help you borrow. You've got to go to the private sector to borrow the money. We've got other things to do. We've got to keep inflation in check. That's our responsibility. And so they say no to the government, and that's supposed to work better, which history says it will. Now, if you think about these reasons, you might want to see what kind of evidence is there. These are ideas, theoretical ideas. How does it work in terms of the numbers? Well, this is an important chart which was put together 20 to 25 years ago originally, which got people thinking about central bank independence and its importance. On the horizontal axis is a measure of how independent a central bank is based on the laws of the country. You can have indices based on this. We'll talk about how the U.S. Has more or less independence than other countries. So on the horizontal axis is this numerical measure of independence. The further on the right, the more independent the central bank is. On the vertical axis is the inflation rate over the span of time that's indicated in the picture, significant period of time. And as you can see, there's quite a significant relationship and association between more independence and less inflation. It's a correlation, not a causation, but when you think about what's going on in these countries, you can see in almost all these cases, what's going on is, say, in Spain, central bank found it was financing the government's deficit. There were the pain then gain scenarios, less common in Germany and Switzerland and in the United States on the other side. There's some ways you can just visualize that by putting a line through it like that. It just helps you visualize things a little bit. And then there's also a couple of interesting case studies. In the late 80s, early 90s, that was the picture of New Zealand, very dependent, not very independent central bank, and it had a high inflation rate. And by looking at these kinds of relationships, the government of New Zealand decided to give the central bank independence, and as a result of that, inflation came down. Another example is the United Kingdom, which was up in the direction of less independence and higher inflation. They too gave the Bank of England, the central bank for the UK, independence, and as a result, inflation came down dramatically, and it's now in the area over where Switzerland and Germany are. Another example which is useful is what happened in Mexico. Based on that correlation, a number of central banks and governments, countries, instituted more central bank independence. It happened in Mexico too, and here's an example just to see how the law affects central bank independence. So just read this. This is the law put in place in 1993 in Mexico, 20 years ago. The state shall have a central bank, which shall be autonomous in exercising its function and management. Its main goal will be to foster the stability of the national currency's purchasing power, thereby strengthening the state's role in guiding the country's development. No authority shall order the central bank to grant financing. So the word autonomous in the second line, that's that independence, which shall be autonomous. And the last line, the last sentence, no authority shall order the central bank to grant financing, is the ability of the central bank to say no to the government. We're not going to finance your deficits. We're not going to make loans. We're going to focus on our job, which is stated in here as well, to foster the stability of the national currency's purchasing power. The results are pretty dramatic. In the years up until this change, the inflation rate averaged 43% per year in Mexico. And in more recent years, the inflation rate's been only a tenth as much, 4%. So these are some examples of how this has worked, and it's an important development in central banking over the years. How does the U.S. get its independence into the central bank? The Federal Reserve was founded in 1913. It had a fair amount of independence then. The law has changed a little bit during that period of time. It used to be the Treasury Secretary would be part of the monetary policy making committee. That's no longer the case, so it's changed a bit, but still there's quite a bit of independence. The governors appointed to serve on the Board of Governors of the Federal Reserve have long terms, as much as 14 years, so that gives them independence from the political process. The chair of the Federal Reserve Board has a term that does not coincide with the term of the president. So the president may be elected and the term of the chair may come up a couple years later, 2 years, 1 year later. It's not the same time, so it's not become an appointee like the Treasury Secretary. And then even more than that, many of the district Fed presidents, the president of the San Francisco Fed or the Dallas Fed, they are not appointed by the President of the United States at all. They're appointed by the local community and approved by the Board of Governors. So that creates some independence from the political system as well. These are all examples of what people would call de jure independence. The law is creating that. But de facto independence can vary from time to time, and that's why it's important to look at what's going on with policy, not just what the law is, but what's actually happening, that is de facto independence. And a quick history of the U.S. shows there's been quite a few changes in de facto independence over time. Sometimes these changes are driven by the executive branch trying to get the Fed to do something, maybe hold interest rates extra low or help with borrowing in the time of war. Sometimes they're initiated by the Fed itself. The Fed feels it needs to do some extra things to help the executive branch, maybe get involved in some markets, the housing market to help, but it occurs both ways. In the 1960s and 1970s, the Fed moved in the direction of less independence by most observers' assessment. William McChesney Martin moved in the 60s when he was chair of the Fed in a degree which was really helping monetary policy stimulate the economy in a way that ended up actually hurting the economy with this boom-bust cycle that we've talked about, the gain then pain scenario. Arthur Burns, appointed by Richard Nixon, started doing the same kind of things. You saw inflation start to rise and the business cycle started getting worse. G. William Miller, appointed by President Carter, all were, if you like, making the Fed less independent, and the policy deteriorated. In the 1980s and 1990s, I think at least until recently, it went the other direction. President Carter appointed Paul Volcker and asked him to get inflation down and focus on that, gave him the independence to do that. Ronald Reagan supported that when he became president. Greenspan was appointed and also continued that for the most part of his term, trying to make sure that the inflation rate came down and not really doing the business of the government in the short run. Volcker looks back on the period before he became chair and says, we have gone a long way towards changing the trends of the past decade and more. In the terms we're looking here, he restored a lot of the independence of the Federal Reserve. As we go into the future, there's a real question about what's happened, or even to the current situation we're in now. The Fed has been more involved in fiscal policy by purchasing a lot of government debt. It's actually been involved in credit policy by helping the housing market. So these are going beyond the usual goals of monetary policy. And of course, the Federal Reserve has reasons for this. To the extent this is a loss of independence, and some economists argue that it is, it's kind of both going by the executive branch asking for some help from the Federal Reserve and the Federal Reserve offering it. This recent move in the 2000s is closely related to the financial crisis, which was a very unusual time. Many government agencies were called on to do more than they normally would, and one of them is the Fed. And the real question for the future is, will there be a change in independence that moves back towards what many people would think would be a more independent Fed, or has the Fed changed as a result of the financial crisis? That's a question for people to be concerned about in a democracy. How independent is the Federal Reserve, how accountable it is. And by using these concepts, you see there are reasons for independence, and sometimes independence comes and goes, and the economic performance depends on that. Thank you very much.